Well, good afternoon, everyone, and thank you for joining us for another installment of our Thursday webinar series. We do webinars every other Thursday, and we're so happy you're able to join us today for our presentation on life insurance, the Timely Tax Tool. And today we're going to be discussing how to control your tax bracket in retirement. And before we get started, I'd like to give a quick commercial about who INSMAX is and what we do. So we share insurance ideas and concepts that solve real-life problems. We work for our advisors, and we have over 20 years experience in the brokerage business, and we work with more than 30 of the major insurance companies in the industry. We provide the training and consumer-approved marketing content so you can approach your clients. We handle your contracting and licensing when your clients want to implement a plan. We handle your pre-underwriting to uncover and address your clients' specific impairments, and we determine the best insurance company for their risk. We give our advisors all the forms needed to complete the applications, and we review the completed forms for errors and omissions. We handle your entire underwriting process from application submission, scheduling exams, to ordering medical records, and negotiating better offers with the underwriters. So in short, we're a full-service brokerage company that you can trust. I like to say we're insurance experts, so you don't have to be. Now let's get into today's topic. Today we're going to be talking about the historical tax bracket changes, national debt, the proposed tax changes by the Biden administration, typical types of retirement assets, benefits that life insurance can have when being used as part of your retirement portfolio, and some examples of how life insurance can change your client's tax bracket in retirement. So will taxes be higher or lower in retirement? This chart highlights all the changes to the top marginal tax bracket since 1913. The top tax bracket has been as high as 90% in the past, with major increases correlating to major historical events. As you can see, during World War I, after the Great Depression, during World War II, we had spikes in the top marginal tax bracket. The answer is unknown. Will the taxes be higher or lower? You can assume that they're going to change now. You can assume they're going to change in retirement. The rates are never going to stay the same. So the national debt, you can see that debt spikes during the same time periods. But now we see a divergence of the national debt and the top marginal tax bracket. We're at a debt to GDP ratio that we haven't seen since World War II. But the top marginal tax bracket are lower now compared to the 80 to 90% levels we saw after World War II. Not only are the debt levels high now, but they're projected to be roughly $1 trillion more new debt in 2021. And due to the COVID-19 pandemic, the deficit for 2021 may be more like $2.1 trillion. So the top capital gains rate history, with top marginal income tax brackets historically being higher than the top long-term capital gains rate, many of the wealthiest citizens in the U.S. derive their income from long-term capital gains. But that rate may be changing soon to match the top marginal income tax bracket. But will that be enough to get the U.S. debt back to an annual surplus and start reducing the national debt? That remains to be seen, but if history tells us anything, the answer is no. And the top marginal tax brackets may need to increase even higher in the future. But many of our agents might say that the tax changes, they're not going to affect my clients because my clients don't earn over $400,000, or my clients aren't having capital gains over $1 million. But the changes in tax brackets can affect even the lowest bracket as well. And the chances are your clients are going to fall somewhere in between the top and the lowest marginal tax brackets. And in a few minutes, we'll show you some examples that are specific to those clients. But you can see the correlation here. When we have spikes in national debt, we had spikes in the top marginal tax bracket, and it does affect the lowest bracket as well. So let's switch gears here and talk about some of the proposed tax changes. So the Biden proposal wants to change the top marginal tax bracket for income over 400 and they want to increase it from 37% to 39.6%. The top long-term capital gains rate for income over $1 million would be increasing from the current 20% all the way up to the top projected marginal tax bracket of 39.6%. They want to eliminate the step up in basis for capital gains taxation. They're going to lower the estate tax exemption for married couples. Right now, they can be exempt from $23 million, and they want to drop that down to 3.5 per spouse or 7 for a married couple. And big one here, the lifetime gift exemption, they want to reduce it from $11.5 million per spouse to $1 million. So now let's talk about what investment options you have to plan for your retirement. We've got a pre-tax bucket, a taxable bucket, and a tax advantage bucket. In the pre-tax bucket, you're going to have your traditional 401k, profit sharing plan, IRAs, and other qualified plans. And you're going to fund those accounts with pre-tax dollars and or get a deduction up front. This is going to grow tax deferred, but your distributions are going to be taxed as ordinary income, and anything that you would pull out prior to 59.5, you're going to have your 10% penalty. In the taxable column, we've got mutual funds, stocks, bonds, real estate, and other investments. They're funded with money that's already been taxed, so you're paying after-tax money in there. They're going to grow and be tax deferred. And when you go to take income, you're going to pay normally at a capital gains or dividend rate. And then we have tax advantaged, where we're going to have municipal bonds, Roth IRA, and cash value life insurance. They're funded with after-tax funds as well, but they're going to grow tax deferred. And with the use of loans and withdrawals, we can take some of that money out on a tax preferred or tax-free basis in retirement. So what are the benefits of these three different buckets? Well, on the pre-tax side, your employer generally will offer you a match for a 401k contribution. Considerations, you might have limited access or a penalty if you want to take distributions, and all of your distributions coming out are going to be taxable as ordinary income. On the taxable side, the no contribution limits, it's liquid, and it's accessible, no penalty prior to 59.5. Investments are going to be subject to ongoing taxation, which will affect their overall growth. And your withdrawals are going to be subject, again, to capital gains or, in some cases, ordinary income tax. The tax-advantaged accounts, they're going to grow tax-deferred and generally have tax-free income. The income limits might prevent you from contributing directly to a Roth IRA, and the 10% penalty is going to apply from anything withdrawn from your Roth prior to 59.5. And again, we're talking muni bonds, Roth, or life insurance. But what we really want to highlight is how the life insurance can help you in your retirement plan. So with life insurance, you have no contribution limit, there are no phase outs. Your cash value is going to be able to be accessible prior to 59.5 with no penalty. Cash values accumulate tax deferred, and distributions that are made via withdrawals to basis or as loans are generally tax-free. And if death were to occur prior to retirement, a tax-free death benefit that's greater than the cash value is passed to the family. We sometimes call that the self-completing pension. So let's look at an example here of clients that have a need of $100,000 of retirement income. This example is called the clients that are stuck in a tax bracket, and what we mean by that is that they've invested only in a 401k, and now all of their retirement income is in one bucket, and it's all going to be taxable as ordinary income. So we can see that the first $19,900, they're going to pull out at the lowest tax bracket, the 10%, and then it's going to step up the more income they need. So the total effective tax rate after they pull the $100,000 out for these three different marginal tax brackets is 13.5% is what they're going to end up owing, and the total taxes due is $13,497. So let's look at the same scenario, a couple that needs $100,000, and this time we've incorporated a life insurance policy. They're going to withdraw the same income up to the second marginal tax bracket, up to the 12%, and then anything in excess of that, they're going to pull out from their insurance policy. So by doing that, they can get their tax bill down to $9,328 because that $18,950 of income that they're taking that normally would have been in the 22% tax bracket is now at zero because they did it from a life insurance policy through a withdrawal or a loan. And their effective tax rate is now 9.3%. So if we look at the summary here, again, you can see that the couple that's stuck, they're going to take out of 3 different marginal tax brackets. And if you use life insurance, you can determine which tax brackets you want to pull your money from. And in this case, we're only pulling money from their 401k for the first 2, and then anything above that, we're going to pull from the insurance policy. The tax savings for them is $4,631. And if you look at their effective tax rate, they were actually able to decrease their effective tax rate to 4.2%, or decrease it by 4.2% down to 9.3%. So this is an example of a couple that needs $100,000. Well, what if your clients are a little more wealthy and they need more income? Here we have an example, same scenario, but they need $200,000 of income. Now they're going to be pulling from even higher marginal tax brackets and pulling more from those higher brackets. So you can see here that the third bracket, they're going to pull $91,700, and there's a big chunk of taxes due in that bracket, $20,174. And in the 24% bracket, the last $27,250 they need to pull to equal that total income of $200,000. They're going to owe $6,540 on that. Their overall effective tax rate, taking into account all 4 of these different marginal brackets, is 18.9%, and they're going to end up owing $36,042 total on the $200,000 of income that they pulled out of the 401k. Now, here's the scenario when we incorporate life insurance. Again, they decided that anything above the second marginal tax bracket, they're going to pull from their life insurance policy. And by doing so, they're able to reduce their tax bill to $9,328. They're paying 0% taxes for the $91,700 plus the $27,250, which will drop their effective tax rate to 4.1%, less than half of what somebody in the lowest marginal tax bracket would pay. So again, here's the summary. We've got our stuck couple. They're pulling from all these different marginal tax brackets for a total, the total tax bill, again, if we back up a slide, was $36,042. And by using the tax-conscious couple and pulling money out of their life insurance policy, they're able to save $26,714 in taxes and effectively lower their tax rate from 18.9% down to 4.1%. So a reduction in their effective tax rate of almost 15% by diversifying their retirement assets and incorporating a life insurance policy. So what we want to try to hammer home here is that you need to help your clients diversify now before it's too late. You're not going to have a client that's nearing retirement that will have time on their side, enough time to fund a life insurance policy to be able to generate the kind of income that's going to be meaningful and beneficial. We know taxes are going to change, and they're always going to continue to change. But the logic would say, based on where our debt level is now, the marginal tax rates are going to have to go up in the future. I don't know where they're going to go, but I think we all can agree that they're going to go up. And your clients are going to have more flexibility and control over the taxes they pay in retirement by adding a source of untaxable income through the use of a life insurance policy.